And you know, whereas otherwise it's just a hypothetical until we can look at what you signed. What's the number? 771-3333. All right, good enough. All right.
Well, in that case, depends on what the paperwork says, but it sounds like she's the owner.
But the bottom line is whether
It's not like he's actually, yeah. In his case, he's probably more the renter than the owner. In that case, yeah. That's what I'm thinking too. That's on the case. Yeah, just for his contents, basically. In that case. All right. All right. But basically, also, guys, we want to keep in mind too, for those folks who are applying, there's a deadline to apply. If you're applying for your actual physical damage, that deadline is going to be in October. It's October the 17th, I think it is, 11th. And they probably extend it to the 13th as well. Now, for the economic injury, for those business owners who basically had loss of funds, loss of income, it's going to be till next year, till March.
I have a snowball thing.
What's that?
What the hell?
Snowball stand?
And I still hadn't got in because the freezer fell behind the door, and imagine, it's a mess, I tell you.
Now, to apply for your loan, you guys can go you have to actually register through FEMA website because they actually track the numbers of the amount of people who are applying for disaster recovery. Even though FEMA is separate from the SBA, you still want to go through FEMA to apply. And there's also, in this area, there's right now 5 disaster recovery centers within this Baton Rouge market right now. Livingston, there's one right here in Baker as well. Actually setting up one in Meade as well as also.
The home stops on the 11th, right?
What's that?
The home stops on the 11th.
It's probably extended to the 13th.
is that also for the nonprofit?
Yes, ma'am. If there's actual damage to the actual nonprofit. So, for example, like a church, if the church had water in the church, or the church, had some type of physical damage, that's going to be until that time frame.
Until October.
Yes, ma'am. Well, 13 technically.
Question.
Okay.
Could the economic injury fall for the church because if half of the membership was lost and the revenue is now down and churches depend on the revenue, could that become an economic nonprofit?
Okay. It's a nonprofit. It's a business. Well, it's not. It's viewed as a business. Okay. And so, be careful how I say that. It's viewed as a business. It's nonprofit. It can. It's also going to pin up to the underwriter as well. But technically, it does fall into that guideline. We've had a few churches that come through the SBA as well for that.
For the economic injury?
Yes, ma'am.
And that's until March of,
Yes, sir. Because some of the members had to actually move because they lost everything. So some of them, they're not here right now. They're actually living with friends and family in other parts of the state. So they lost membership.
You may have already answered this question, but when you're evaluated for a loan on your primary residence, let's say that you have a home with a value of $200,000.
Okay.
You had in a flood zone X, and no flood insurance not required, so you don't get anything out of your insurance. You had,
Okay.
right? You have significant damage,
Mhm.
but you have a loan balance say of 180, but you have probably $100,000 worth of work. You only loan that equity amount that's in the property.
They can go up to the amount that's needed to actually get the home back in order. In cases like that, even though the insurance company did not pay out because the insurance company didn't pay anything. There's no insurance. Yeah.
There's no property.
So for the property, they can go up to $200,000 depending on the value of the home. So they can cover that amount, even if there's no insurance to pay. Because the insurance
They'll
can
cover up to the value. So whatever your
can.
equity, they'll cover that equity.
They can fill in that
So
gap.
you get a loan of $20,000. That's it.
Technically. So it fills in the gap to take care of the house to get the house back
So
in
the
order.
gap is
It's not much depending on the value of the home. What happens is they send the SBA rep out to the house, they do an assessment on the property, they look at the comps in the area. So you kind of get an idea of what the house is valued in the area, pre-storm or pre-disaster. You kind of get a good idea of what the value would be if the house was to sell today. So you base it upon that number, based upon the comps.
May not be that mortgage. Maybe to your best interest in
It could be.
Look at the other
It
property.
could be the other properties.
right. But what you're telling me, you're only going to get a loan for that equity that you have in that property.
You're going to get a loan for that gap,
That gap, that equity
Market value.
fair market value, depending on the,
between the loan balance and what that fair market value is.
It also depends on the damage, though. Depends on how much
Right,
damage
but
is in the house.
what the damage for exceeds that.
Yeah.
And
Yeah, because you can't go past the value of the home.
The value of the structure or value of the home?
What's that?
I said, is it the value of the structure or the value of the
Value as a
whole?
whole. Because what happens is if they put so much amount into that, they can't resell.
Right.
Yeah.
The person will be.
Upside down in their house.
Upside down.
Exactly.
Mortgage value.
Exactly.
And we are talking about fair market value before the disaster, because it stressed fair market value. And in fact, I'm not even sure what that's gonna be at this point, because in our neighborhood, people have private signs up talking about selling their house, and what are they gonna sell that for?
And that's the dilemma as well, because you're right. So pre-disaster is what you know what your house is valued at. But the SBA could, that rep may say something different. Depends on the market area and the value itself. But there's cases where, you might say it's this, and they look at the whole entire area after the fact and say, well, it's this. So it's kind of case-by-case scenario. It's not a set number, not a set aspect on that. So it just kind of depends on the market, kind of depends on the neighborhood too.
So is it market value as it's currently valued, current comps?
It's going to be pre, but also they're going to do an assessment of what the value could be after the fact as well. It's kind of a hard number to speculate on because each neighborhood is different.
This is the time that you want your house to be high, and when the assessor comes around, you go up.
Yeah. There you go. That's what you got that. Exactly. Yes.
I mean, the
The issue for a lot of people is whether the value of your home is going to be damaged more than 50% of the value of your home, right? Because that's going to determine whether you have to lift or not lift.
Yeah.
And so that's an issue. Is it 50% of the structure or 50% of the property? And then, like you said, who's to say what the value of that home is?
Exactly. And so they do their own estimation from SBA. They have their own agents look at that and do a fair market value on the property of what they think it's going to be at that point in time.
The SBA loan? I think your question right now dealt with the local code enforcement, but does the SBA loan come with any lifting requirements?
I'm not sure to check with SBA on that because I don't work for SBA.
So, let's say you buy a house for $100,000. You put $20,000 down.
Okay.
Is there a way to have the mortgage company apply for an SBA loan to preserve the house, or is that just not
No.
even an option?
Not for a homeowner. Question?
To address the question about the value of the house, before the storm came around, the real estate companies, I went to a seminar, and they had stopped, like certain areas, our middle class areas, homes go here for $150,000 to $200,000, but they had started going around checking to see if the home had been updated, and they had started downsizing those prices if they hadn't been updated. So general economic sense would say, with the storm coming around, if the house had been worth for most of these middle-class subdivision on the other side of the Plank and Airline was $150,000 and up, well, they're gonna be able to deduct what construction that they have to put into that house. If it was $150,000 already, then they're gonna get a contract, the real estate company gonna be able to get a contract to go in and say, okay, this much has got to be done. So they're gonna downsize that price for what it was on that tax value before, this after half. That is good, business.
Yeah.
Do that, huh? Let's try that.
So you don't know if the SBA is going to mirror any policies of the local government as far as raising houses?
I wouldn't have that answer, no, sir. That'd be
Okay.
through the SBA.
Okay, when would they come out with something like that, or when would they make a decision?
If you contact the SBA, they should have that information. All right.
Other requirements for the, I see the rate for the nonprofit and the economic injury nonprofit the same.
Yes, ma'am.
Okay. Are the requirements different? Are the same requirements for all of them? There's certain requirements that they have to meet for economic injury loan?
Well, that's based upon if there's actually loss for the actual business itself. The other loan has to do with more the property damage, the actual building itself, the structure, and that's what they factor into that. With the economic injury, they're looking at basically P&L, net loss, things of that nature. So it's two different factors. They're looked at a little bit different because one is involving actual physical property, the other one is involving how the business functions.
Only thing it looks like that if you do the economic injury, you get a little bit more time to get everything together, correct?
It's a little bit different, right? Yes, ma'am. But it's actually handled very differently. All right, are there any more questions? All right, guys. Well, thank y'all for help. And back. Okay.
I have a property of 6,000 square feet, and now, because of this flood, I've had water damage, but it's a flat roof. It found its way in. And this church wants to rent this property from me. Now that the water's come in, can I receive some type of assistance to repair this roof, and they put air and central heat in there for them?
The water happened from the event from last month?
Not slightly. It was before, slightly. Now it's ridiculous. I'm just being honest.
Sure, I understand.
And it's ridiculous, terrible now, but the church still wants, it's not as bad, they can still use the facility.
Yeah, it has to, in this particular case, all these applications are from events from the actual water flood from last month, the flood of 2016. So let's say, for example, if we had water, rain real bad 2 weeks after that, that's a little different. They're going to ask those questions around that. And so it's based upon the actual incident of the actual flooding. Question, sir?
When folks write their academic papers, they get to chapter 5, and chapter 5 talks about what's next. So I just asked the professor here, could Southern consider the codes and permits? Because I've been talking to folks here in the room and neighbors and that sort of thing, and I don't have a good handle on what permits I need to build back, what mold certifications, electrical certifications, and it would be very good. And if Southern could do another one, I'm sure we would all come back for it. Thank you, sir.
In fact, I can tell you that our next run is actually we're working on going out to community locations. Because we know logistically it's not easy for people to get here. In other words, we literally have to figure out what time of the day, when do we have to do it. Now, I think what we've learned from today is that Friday afternoons are probably better because that there's no classes on the undergraduate campus, because I already heard people talk about I had to walk a long way because of parking, right? So that's one thing we learned. But the other thing, in the group that preceded you with Louisiana Appleseed, we're already talking about creating workshops in locations in communities. We're talking about St. Paul Catholic Church, for example, already. We're talking about the Charles Kelly Center. I mean, we're already planning and dealing with that. We've been talking with the School of Business. They want to start doing some stuff on Saturdays. Yeah. Already. I mean, so all those things that you're talking about, we're thinking through. And what I'm beginning to see is that, and I'm beginning to get responses, is people want to know, I've got a mortgage, I either didn't or I didn't have insurance. I'm concerned, is it worth it for me to keep the property or do something else? Yeah. All right?
Then if I keep the property, then how do I make it such that I can actually transfer the property?
Exactly.
Permits and all of that.
We hear you. So again, what we're learning today, is this. We wanted to kind of cover a broad area to just kind of see where we were, and then based upon what we learned today to say, okay, what can we really clamp down to what's the real heart of the deal, because that's why we're doing this today. So yes, we hear you, and we will provide that information. In fact, all of you did a sign-in, right? All right, so one thing I didn't see on the sign-in is email addresses, right? All right, so I think it'd be valuable for us to have email addresses to capture that, to say, okay, we're gonna have another event at this location, we send it out to you, and you can come out to that particular location. I mean, I think that makes sense. Okay, all right.
On the radio, that's where I got it from.
You heard it on the radio? Oh my God. Well, we put up the word out. Well, Channel 9, yeah. Okay, well, good, but we hear you. All right. Oh, yes, absolutely. Okay, well, let me, you know what, we'll give it a web, we actually have a disaster recovery webpage. On the page, it's I think, what does it say, SULC recovery? What does it say, Greg?
Disaster recovery.
Exactly, disaster recovery. If you go on our website, we have a disaster recovery website.
And SUBR.
SULC, no, not SUBR, this is SULC.
SULC.
www.sulc.edu. All right? That's right. Yes, I mean, so, and then you just, so yes, yeah, that's exactly, and we send out stuff. We actually have, let me make sure, we got Facebook, we got Twitter, all right, and we'll send it out there.
But you can tell from how well attended it is, we're hungry for the
I can tell.
Baby, this is stuff.
I can tell. So good. I mean, so here's what we'll do. You can hold me accountable. I'm John Pierre. You can hold me accountable. All right. We will do more. Okay. We will do more, and we already are planning for the month of October. We just literally, a couple hours ago, we just started thinking about what's the dates. All right, and I'm telling you right now, we're looking at some dates in October. We may try to do something in late September, but for sure in October.
Yeah, it's a long process.
It's a long process, so that's something we're continuing to do, and so we've been having conversations. So this is not a one-shot deal. Okay.
As a suggestion, late September might be good, so we don't actually put stuff up and then find out we had to rip it back down.
All right, well, we'll see what we can do for late September. But I know we're planning some stuff in early October. I can't make a promise about Lisa, but I will try. Okay? All right? Good enough. All right, so. All right. We got our star. We got one more person.
We got 10 minutes.
We got a star right here, Christopher Patillo.
All right, I'm going to try. My name is Christian Fasulo. I am the supervising attorney for the Taxpayers Clinic here at the Southern Law School. I'm going to try to put the tax aspects of a casualty, such as the flood, hurricane, things like that, into about 10 minutes, okay? First and foremost, when a disaster happens like this, and we are a federally declared disaster area, generally, the federal government extends deadlines to file tax returns. If you had a tax return, whether it's your personal tax return, a business tax return, S corporations, partnerships, LLCs, things like that, the Internal Revenue Service, if your filing deadline was August 11th or after, or if your original filing date was before that, but you filed an approved extension, you have until January 17th to file those returns. Okay, what you need to do is on the top of those returns, put on there Louisiana severe storm and flooding, and you just write it on the top of the return. That way they know that you're in a disaster flood area, and the new filing deadlines apply. This is 941s, payroll tax returns,
all the tax returns if your deadline was after August 11th. Okay, so talking about what is tax deductible in dealing with casualties, such as a natural disaster. And I do want to point this out. Everything I talk about in the next 10 minutes will be basically Form 4684. The questions that I'm going to ask and the analysis I'm going to go through right now, they're basically questions listed on this form. It's a 3-page form. It kind of leads you kind of specifically through it. This will be attached to your personal tax return. The numbers here will go on your Schedule A, and then we'll eventually get on the second page of your personal tax return. Now, what is tax deductible? First of all, there has to be a casualty, a sudden event that was unexpected and unusual. Well, obviously the flood was, okay? That can be a fire, a flood, a hurricane, but it's got to fit all three: sudden, unexpected, and unusual. Like I said, obviously the flood fits that. Then we have to realize we have to prove that we were a victim of it, okay? Now, if you lived in one of the federally declared disaster areas, it doesn't necessarily automatically mean that you were affected by it. Some houses were high, some houses were low. There has to be some sort of proof. First of all, you have to prove that there was a casualty. Obviously there was a casualty, but you have to prove that it affected you. Something as simple as standing in front of your house with a picture. That's your house, you've got water lines, or there's 4 feet of water in your house. Walking through a few pictures, okay? That pretty much speaks for itself. The second one is that the disaster affected you personally. Again, the photograph kind of speaks for itself. The third one is you actually have to prove that you own the property. In order to take a tax deduction, you have to prove that you are the owner of the property. Now, we talked a little earlier about title issues. Under Louisiana law, the minute somebody passes away, title is transferred under law, but you have to go through the succession process to be recognized as the owner, okay? So, if the title to the property is in your name, then you can deduct some of the casualty losses. Now, there's a slight wrinkle for leased property, okay? If you're leasing an apartment, generally you can't take a deduction for the damage to the property unless the lease itself contractually obligates you for the damage to restore the property. That's something along the lines of a triple net lease. We use that in business, okay? Anything less than what we call a triple net lease, meaning that you're not contractually liable for any type of damage like this, then casualty losses with respect to the structure, you won't be able to take those, okay? Now that we've established the disaster happened, we've established the proof that we have to have, how much loss can we deduct? Quite frankly, in a simplest form, everybody's situation is going to be different. But this is what the analysis looks like. They're going to take one of two things: your actual basis in the property, and basis is, first of all, it starts off with the actual acquisition price. Basis can be adjusted up if you make improvements, such as the remodel of the kitchen. You put a new roof on it. Anything that you come out of pocket for that in the past insurance didn't pay for. So, for example, the roof. You had hail damage. Insurance company puts an $18,000 roof on it, but it costs $20,000, so you're out of pocket $2,000. That $2,000 increases your basis. The insurance company covered the $18,000, so that doesn't increase your basis. So whenever you're talking about basis, it's the acquisition price plus any improvements that you came out of pocket. Then we're going to analyze the fair market value of the property the day before the storm and then the day after the storm. And you're going to take a look at what is the reduction in fair market value of the property. And then, not to complicate things more, but then we're going to compare your tax basis and the reduction in the fair market value, and we're going to take and use the lower one. So, for example, if the fair market value of your house was $150,000 before the storm, and the day after the storm, the fair market value was $50,000, your reduction in fair market value is $100,000. We're going to compare that to your basis. If you bought the house 45 years ago for $80,000, then they're going to take the lesser of the two. We're going to start off with using the $80,000. Okay? Now, where do we go from there? We're going to start off with our basis because that's the lesser one. Then that number is going to actually be reduced by the amount of insurance proceeds that you would receive to rebuild the house. So let's say the basis is $80,000 and you receive $45,000 worth of insurance proceeds. Now all of a sudden your loss has been reduced to $35,000. And not to complicate things even more, but there is a $100 deduction for each event. So we take that $35,000 and we reduce it again by $100. And again, not to complicate things more, adjusted gross income. Then that $35,000, well, $34,900 is going to be reduced again by 10% of your adjusted gross income. So let's say your adjusted gross income, I don't know, is $50,000. Okay? 10% of that would be $5,000. The $34,900 would be reduced by $5,000. Now you can see why everybody's situation is completely different. Once you reduce that, that is what your actual casualty loss will end up being. Okay? Now we do that analysis for the primary home, but you also do that for the contents. You'll also do that for the car. You'll go through that same type of analysis. And again, 4684 asks you those questions. And you can see each column is a piece of personal property that you would claim. Okay? And so once you kind of know what questions to answer, where to put the numbers, if you do your income tax return yourself, the software should do it. Your professional, the software should do it. Yes?
What did you say needs to be written at the top of the form?
Louisiana severe storm flooding. Okay? Now, once we take a look at this, there are some caveats to this. I know this is a disaster, but believe it or not, there is a scenario where you would actually have to pay taxes on getting your house rehabilitated. Here's the scenario. Remember the analysis where we take the fair market value before, fair market value after, we take the reduction in fair market value. Then we look at the tax basis, and we take the lesser of the two. If our tax basis is $80,000, and the insurance company comes in and says, well, you know, the fair market value is $150,000, and it's going to take you, oh my gosh, it's going to take you $100,000, $120,000 to rebuild this thing. The $100,000 ends up being more than your tax basis at $80,000. So the difference between the two, yes, is taxable income.
Oh my goodness. What insurance proceeds?
Well, it's the tax basis. You originally, 45 years ago, paid $80,000 for the house. Now, we know we can't build a house 45 years later for the same price. And so in order to rehabilitate the house, sheetrock's gone up, labor's gone up, all the trimming, the flooring, all that's 3 times what it cost 45 years ago. So in order for the insurance company to give you enough money, hopefully, to rehabilitate your house, it's going to be more than your tax basis. Any insurance proceeds that are over and above your tax basis in the home is going to be taxable. Now, there is a scenario where your home may be absolutely just a disaster, where it's uninhabitable and quite frankly, it'll never be inhabitable. It was just completely destroyed. Well, at that point, if FEMA or the insurance company comes in and says, we're just paying you off the house, do with it what you want, that, under the Internal Revenue Code, is considered a deemed sale. Whatever the insurance company gave you over and above your tax basis, it is considered a sale. Okay? That potentially could be considered income. However, there's an exception. If you've been living in the home for 2 out of the last 5 years as your primary residence, if you're single, $250,000 is tax exempt of gain. If you're married, filing joint, $500,000 of gain is exempt. So for the most part, for those people, average American out there, their house is completely destroyed. The insurance company is paying them off. They're walking away from it. There is technically that tax basis and gain from the insurance. However, they're going to apply the exception. The exception is if you're single and you've lived in the house for 2 out of the last 5 years, it's $250,000 of gain. If it's married, filing joint, it's $500,000 of gain. Okay? That's kind of the caveat. And I got three more minutes. Okay, so when we're taking a look at this, how do we go about determining the fair market value? Well, if anybody happens to have an appraisal that was fairly close to the flood before it happened, that would be great. As we've talked about, other people have talked about in the SBA loan section, market analysis. They're going to go price per square foot. They're going to look at other houses and things like that. What does not go into calculating your loss is cleanup. That may be money coming out of your pocket to clean up your house, but that's not part of the loss. It is used to help determine the fair market value after the flood. Okay, but unfortunately, those things are not going to be losses that we can deduct. Can I decide not to make an insurance claim? Because what that does is that reduces my loss. Well, I think we probably all know the answer to that one. No, you can't just say, well, I'm not making a claim on insurance. That way my loss is huge. No. If you have a viable claim and you have insurance, the Internal Revenue Code says basically even if you don't apply for it, they can take that into account in reassessing your loss that you take. Okay. I will say this, that some of the rental assistance and food assistance payments that FEMA gives you or insurance companies give you, those are non-taxable. Okay, there is a bright side. There's a bright spot, huh? There's a bright spot. So whenever you're taking a look at this, as far as personal assets, you're going to determine fair market value, you're going to determine basis, and that's going to be for the home, that's going to be for your furnishings, all the furnishings together. That's going to be for the cars, and you're going to come up with each individual loss. If it's from one event, you're going to add those losses together and subtract $100. And then you're going to subtract 10% of your adjusted gross income. If it's multiple events, then it's $100 per event. Okay? Now, when we talk about business property, okay, rental property, and I'll breeze through this real quick because we've had some questions regarding rental property. We don't do the fair market value analysis at all. For rental property, you basically start off with what your cost basis is. Then that's going to be either adjusted up by improvements or adjusted down by depreciation, but you're going to come up with your tax basis on the day of the event. Then what we're going to do is we're going to subtract insurance proceeds. Then we're going to come up with the loss. Okay? And that's, it's going to be the tax basis minus your salvage value. At some point, for most structures, the salvage value is pretty much zero. If it's for equipment, trucks, things like that, there's an actual salvage value. Even if it's just scrap metal, there's a salvage value. So the truck may be $20,000. After the flood, not even the tires hold air. Okay, but you can go take it to the scrapyard down on Plank Road or Scenic Highway, and you can get something for it. That's going to be your salvage value. So let's say it's $500. So now all of a sudden it's $20,000 minus $500. It's going to be $19,500. Then you're going to subtract from that the insurance reimbursement that you would get, and whatever's left over is going to be your loss. Anybody who owns a business that has inventory, okay? If you have inventory, what we're going to do is we're going to take the cost of that inventory. So whatever you paid for that inventory, we're going to add up everything that was lost. For you business owners, hopefully you'll recognize this. Then we're going to reduce our beginning inventory by the amount of the loss of inventory. And then we're going to increase the cost of goods sold by that amount. That calculation takes care of the losses for inventory. Okay? I hesitate to ask any questions at this point. Yes?
All right. With the form 4684, do you itemize the items that you're going to?
On the form, it has columns A, B, C, D, and you can have as many of these forms as you need to attach it to your tax return.
Okay, so
it's not going to be each piece of furniture like the desk, the ottoman, the chair. It's going to be household furnishings.
Oh, all right. That's what I need.
Okay, but it's going to be, yes, ma'am. Yes. Yes, they have to, and in fact, they're going to have to file Schedule A because everything on 4684 ends up on Schedule A, which ends up on the second page of your personal tax return. Yes. Yes.
One thing, Chris, why don't you make a distinction between you own the property that you rent. So we know if you own that's your primary residence, it goes on the Schedule A. Where does the loss when you own property that you rent?
Rental property.
Yes.
That's going to go on Schedule E, of which you're reporting all of your income and expenses anyway. Yes, sir.
Chris, can you explain the inventory now?
Yes.
Like, you have like an online, maybe like an online boutique, and I think the starting inventory was $2,000, and they may have sold about $500 to $600 of it, but after the flood they lost all of the.
Okay, well, I'll use your numbers.
Okay.
Beginning inventory January 1st, 2016. Inventory was $2,000. Up to the flood, they sold $500 worth. Okay, which means right up to the flood, their inventory was $1,500. If they lost all of that, then that means they're going to adjust beginning inventory to $500. Then their cost of goods sold is going to end up being the $500 they sold plus the $1,500 that they lost. Okay, that's going to be in cost of goods. So that is actually going to account for the losses that they sustained. The other thing that I do want to mention real quick is, and this may or may not be important to you depending on where you are in the process. Once you calculate all of your losses and you realize where you are, and I realize some people haven't even finished ripping out their houses and they're still trying to figure out where they are. But those that have, you can calculate these losses and go back to 2015 and amend your tax return and get a refund. And any losses that do not get used up on 2015's return, you can put them on 2016's return. Okay? So that amending the 2015 return can get you an immediate refund of the taxes that were owed. Yes, ma'am.
Well, I've heard that, but I mean, if the storm didn't happen until 2016.
No, it's the statute. The statute allows you to go back and amend and get it immediately.
Okay.
And right, presidential declared disaster area.
Special rule for presidentially declared disaster area.
All right, one little wrinkle to that. So if you have an extension and you haven't filed your 2015,
You can include it on there. There's nothing to amend.
that's right.
Right.
Yeah, okay.
Yes. So any losses that are not used in 2015 or 2016, we call them net operating losses, you can carry them forward until you use them. Okay? Now, there are scenarios where, believe it or not, it's not worth it to you to take the loss. Believe it or not. And here's why. If we go back and amend 2015 return and we get the refund and come December, you get insurance proceeds, you either have to go back and fix 2015 or those insurance proceeds are included in income for 2016. That's just kind of a risk we all take. Okay? Any other questions?
All right, well,
Okay.
I want to thank Professor Sabula. I thank y'all for coming. And again, we will be going out in the community, so we're working on that right now. Okay. All right. All right. Yeah.